So, the Chancellor's 2025 autumn budget is out, and it's not just a few small tweaks here and there. Nope, we're talking about a pretty major multi-year plan that's going to bring some big tax shifts, and these will almost certainly affect your finances. So, let's get right into what you really need to know. And let's be clear, this isn't just about tinkering around the edges. It really feels like the government is signaling a fundamental shift in its tax strategy, one that's going to touch on your personal finances, your pension, and how businesses operate across the UK. So here's how we're going to break it all down for you. First, we'll look at your personal tax bill. Then, we'll dive into what's new for UK businesses. After that, we'll cover the government's big push to close tax gaps. And finally, we'll wrap up with what you can do to get ready for all of this. All right, first up, let's talk about the stuff that hits closest to home, your wallet. We're going to look at how this budget could affect the money you earn, the money you save, and of course, your plans for retirement. Okay, if you look at this table, you can see a pretty clear pattern emerging. Taxes on income from assets are going up. It seems like a strategy to shift more of the tax burden onto investment returns. So starting in April 2026, the tax on dividend income is jumping up by 2 full percentage points. Then from April 2027, the basic rate for both property and savings income goes from 20 to 22%. The bottom line here is pretty simple. The returns from your investments are going to be taxed more heavily. So, when is all this actually happening? Well, it's not all at once. This timeline shows you how they're rolling it out in stages. The dividend tax hits first in 2026. That's followed by the property and savings changes in 2027. And you see that third date, the one a bit further down the road in 2029? Well, that brings us to a really significant new rule for pensions. And this next one is specifically for anyone who uses a salary sacrifice scheme to boost their pension. You know, it's a super popular, really tax-efficient way to save. But a big change is on the horizon. You're going to want to remember this number. £2,000, because starting in April 2029, that's the new annual cap on how much you can put into your pension through salary sacrifice without paying national insurance. Any amount you contribute above that £2,000 limit will now be hit with both employer and employee national insurance. So while you'll still get your income tax break, that national insurance benefit is being capped. And a quick one for any UK nationals living abroad. There are some important changes coming to your national insurance. From April 2026, you won't be able to make those cheaper Class 2 voluntary contributions anymore to top up your state pension. And if you want to make Class 3 contributions instead, you'll now need to prove you've lived or paid NI in the UK for at least 10 years. Okay, let's shift gears. Now we're going to look at what this whole budget means for businesses. We're talking new rules, new reliefs, and a few things for employers to watch out for. First, let's kick this section off with some good news for employers. The national insurance relief you can get for hiring military veterans, well, that's been extended for another 2 years. It'll now run all the way until the 2027-28 tax year. And here are a few other key updates for employers you'll definitely want to be aware of. First, any payments for cancelled shifts, they're now officially going to be treated as earnings, so they'll be subject to tax and national insurance. Now, for those working from home, there's a helpful little simplification. Starting April 2026, if an employer reimburses you for equipment, eye tests, or flu jabs, that money will be tax-exempt. Looking a bit further down the line, real-time reporting for most benefits in kind becomes mandatory from 2027, and those employee car ownership schemes will be taxed as a benefit starting in 2030. Next up, let's talk about closing the tax gaps. A huge theme running through this whole budget is the government's plan to crack down on non-compliance. They're rolling out a whole bunch of new measures to tackle tax evasion and avoidance. Whoa, okay, this is one of the biggest changes announced for sure. The 100% capital gains tax relief you could get for selling your business to an employee ownership trust is being sliced right in half, down to 50%. And this one is happening really fast. It takes effect on November 26th, 2025. And here's a really interesting one. The government is also taking some pretty dramatic steps to encourage whistleblowers. They're introducing a new, much stronger reward scheme for people who provide intelligence on major tax evasion. And they are not messing around with these rewards. We're talking 15 to 30% of the money HMRC gets back, all for high-quality information on cases over £1.5 million. And get this, the rewards are completely uncapped. It's a real signal they want to uncover some serious noncompliance. This whole crackdown isn't just for big corporations either. It's also hitting the high street. They're setting up a new team of 350 criminal investigators to target fraud, especially illicit tobacco and vaping products. There's also up to £10 million in new funding for Border Force, and the government is even planning to look at new software to stop cash-based tax evasion. Okay, business owners, listen up. This is a simple but really important one to know. Starting April 1st, 2026, all penalties for filing your corporation tax return late are going to be doubled. Yeah, doubled. The message from the government here is crystal clear. File on time, or it's going to cost you a lot more. So, after all that, what should you actually be preparing for? We've covered a lot of ground, so let's boil it all down to the key takeaways and what your next step should be. So, what can you do? Here's a quick action plan. First, pull out your calendar and mark down those key dates, especially for 2026, 2027, and 2029. Second, now's probably a really good time to review your financial planning, particularly around your investments and pension contributions. Third, if you're a business owner, you need to get ready for those new reporting rules and, of course, those doubled penalties. And finally, if you want to have a say in future changes, keep an eye on the official consultation page on gov.uk. You know, this quote really hits the nail on the head. These aren't just one-off adjustments to get through the next year. The changes we've talked about represent a genuine long-term shift, and they are designed to shape the UK's tax landscape for many years to come. And that really brings us to our final thought. With all these changes being phased in over the next 5 years, the crucial question you need to ask yourself is this: how is this long-term plan going to shape your financial future? Thanks for watching.